equity markets were also shaken by the US election. US indices have reached new record levels. We did not make any major changes to our price targets based on the outcome of the election. This is because the implication of the change of policy in the United States are simply not yet clear. While US equities might benefit from deregulation and the fiscal program, they could equally suffer due to further dollar strengthening and wage pressures. In addition, rising interest rates argue against increasing the valuation multipliers. Among the other regions, Japan still has a weak domestic market, but we consider it still as the greatest potential from measures by Japan's companies. Many have started to distribute some of their sizable cash piles to shareholders. In the emerging markets, higher US interest rates and Trump's foreign and economic policy may well cause uncertainty. However, we also believe that the markets here are very interesting in the light of progressing economic recovery. European equities, especially German ones, could ultimately benefit from this. In any case, the most recent corporate results from these markets again looked encouraging. Overall, we expect slight growth in corporate earnings. In equities, we are again expecting volatile sideways markets. Most indices are trading close to our targets already. This means that we will again be concentrating on three things: stocks with a good dividend profile, excessive market movements for tactical positioning, individual stocks in attractive sectors such as technology, healthcare, and energy. We remain skeptical regarding utilities and defensive consumer goods stocks. So, overall, we are not expecting major leaps for the coming year. But is that so bad? For 2017, we are at least expecting the global economy to grow by over 3% for the 8th successive year. And we anticipate that we can achieve reasonable returns by drawing on experience and being prudent. These are not bad conditions for the new year.